Okay, here's another one of my podcasts with an expert deal maker. You're going to hear how to revive pending deals that are troubled, deals that are worth making. It's no fun when deals fall through, and you could leave a lot of money on the table, especially for deals that should complete but don't, because of what seem to be irreconcilable differences between the buyers and sellers of small and mid-sized businesses. In this podcast, you're going to hear about revival, getting back on track, deals that should occur. I'm Ted Leverette, the original business buyer advocate. For more than 30 years, I've been helping people find and buy the right businesses the right way. I'm not a business broker. I don't sell businesses. You're going to hear Hal Feder of Murphy Business Sales. He'll tell us how he revived troubled deals, deals that were worth doing. And you're going to hear more about him later. So Hal, what was the problem and how did you help the parties get back onto the same page?
Thanks, Ted. Thanks for having me. You know, the biggest deal killer out there is the business is just not priced on the market. It's unrealistic and they don't disclose all the items. So the thing that I try to coach my sellers is view the deal from the eyes of the buyer. Become the buyer, because you've got to understand where the buyer is coming from. And that means doing your homework, doing the buyer's test. What's the buyer's test? Well, it's a deal that covers the salary, a reasonable return on investment. It takes care of the capital acquisitions, and it covers the debt service. So if the business is not priced to do those four things, then it's probably overpriced. You also want to be careful about what you add back. That's a problem. You have to have a realistic add back that the bank will recognize. I had a deal, Ted, that the seller was adding back distributions from retained earnings. Okay, now he was doing that every year, so he viewed it as operating cash flow. But when it came to the bank recognizing those add backs, they just threw them out saying that is not operational cash flow. So it blew up his valuation by not accounting properly for add backs. The other thing you want to do as a seller is fully explain the rationale behind your pricing. Look, the buyer may not necessarily agree, but he'll at least know where you're coming from, and it will promote a conversation, an intersection of interest, because that's what this is. Deal making is just an intersection of interest. So by fully explaining your pricing rationale, you start a conversation that can lead to more intersection. And that's what we're trying to do as a business broker. Obviously, another big one is to fully explain the growth opportunities in the business. Now, buyers won't want to pay for future opportunities, but I've got a situation right now where I had a gap, and I went through and I carefully explained the upside potential of the business. And so I was able to narrow that gap. I find more intersection by talking about the growth opportunities of the business. At the end of the day, Ted, you know this, there's really only one price for the business: the price that the buyer is willing to pay and the price that the seller will accept. Sometimes you can't get there, but as a broker, I always look for ways to try to find more intersection. Of course, that's not the only problem, right? There are other problems out there. The next one is you just can't get the buyer financed. This is when I encourage my buyers to view themselves in the eyes of the seller. Again, looking for intersections. So if I have $200,000, I can't necessarily buy the $2 million business, because I've got to not only fund the acquisition, I'm going to have to fund the working capital. So you want to right size your aspirations with the capital that you have to invest. So what I try to do, if they don't have the right size capital investment for the business that they called into, I try to find them another business. So I transition them to a business that they can afford and that I think they will be interested in. There is a way to stay on that original business. So I probe and see if the buyer has a trusted partner or an equity investor that can manage or fill that gap to what he has to put down versus what the business requires to put down. Another example, I had a deal where the buyer and the seller hit it off so well that I was able to form a partnership between the two. So instead of buying 100% of the business, it wasn't seller financing. We did a buy-in, partner buy-in. So he bought 80% of the business at closing, and the two of them were confident in one another, and they worked out a deal to, over time, replace the additional 20% that he didn't have at closing. Seller financing, I had a deal last year at about $1.5 million gap. And I sat down with the three brothers and I said, okay, we need $1.5 million in seller financing. That's 500 for you, 500 for you, and 500 for you. And we were able to get it done. It ended up being a $7.5 million deal. Saved the deal because they told me, no, we're not ever gonna consider seller financing. But when I broke the $1.5 million down over three parties, it was only 500,000, right, for each brother. So I was able to, again, find that intersection, and you never want to give up on a $7.5 million deal. The other thing that you try to do is maybe there's a key manager in the business, Ted, where they don't have all the equity they need to buy the business, but they can supplement the person coming in. So you do a couple things there. You close the gap on the equity because the key manager brings some capital into it. And then for the buyer, you lock up a key manager in the business. Okay, so you've got a significantly reduced risk because you've got a key manager now who's part owner and can make for a very smooth and effective transition of the buyer in the business. Sometimes you have to separate the real estate. You know, they've got a lot of money, but they can't get the real estate. You pull the real estate out of the deal, it lowers the required down payment, and then you do a lease purchase option, and you do the real estate over time through the profits and the cash flow of the business. So both of those are really tricky. Business is not priced right, and the buyer can't obtain financing.
Okay, Hal Feder, this was very entertaining and informative. Wait, what's a quick and easy way for people to get in touch with you?
Yeah, probably the quickest way. I'm very active on LinkedIn. So check my LinkedIn profile. From there, I'll get you whatever information you need.
Okay, here are two more resources that are helping people wanting to buy a business. First, my book for searchers, How to Prepare Yourself and Find the Right Business to Buy. And when you've found that business and you're beginning to get into due diligence and facing some of these issues, my other book, How to Buy the Right Business the Right Way. You will save time, you will save money, you will achieve better deals, but you have to do what the savviest buyers do. I'm available to help you deploy the tactics and the strategies from those books. You can get them at my website, partneroncall.com. I'm Ted Leverette, the business buyer advocate with Partner On Call Network. Oh, hey, let's Zoom if you want to continue this. Okay, thanks for listening.